Welcome to this valuation masterclass final presentation. Today, we're going to be hearing about Chevron. Would you buy it? Would you sell it? What's going on with the company right now? Well, you're going to learn about Chevron from one of my students in the Valuation Masterclass Bootcamp, number 19. Boy, she has worked hard to get to this point. Anusha, how are you?
I'm good, Andrew. How are you?
Excellent. I'm really excited to hear your presentation. You've done so much work to get to this point. For the people that are listening and viewing, we're now in the final week of the Valuation Masterclass Bootcamp, number 19. And how many hours do you think you've worked so far in the bootcamp to get to this point?
I think I've worked more than 100 hours.
That's amazing. And we're going to talk about what you learn in your transformation at the end of this. But I think we really want to get started. Now, I know we do have some people watching, and particularly I see Moments giving you a go, go, go. And you've got some of our friends in the Valuation Masterclass who are here to say, make it happen. And so you've got your fans out there. And I want to just say to the audience, make sure, ask any questions. Now's a chance. We've got a great discussion on Chevron. So what I'm going to do is I'm going to bring up your presentation, and then in just a minute, I'm going to exit this screen. So are you ready?
Yes, I'm ready.
Okay, I'm going to exit now, and as soon as I exit, then you start exiting now.
Okay. Good evening and namaste, everyone. I'm Anusha Kulkarni, and this is my report on Chevron. I initiate coverage on Chevron with a buy recommendation based on a target price of $195, implying an upside of 30%. I derive my target price from a DCF based valuation using a WACC of 13.4% and a terminal growth rate of 1%. The highlights for Chevron are as follows. Tengiz oil field in Kazakhstan expansion is set to fuel sustained revenue growth and investor returns. AI power plants offer vast growth opportunities. Chevron refines strategy by balancing growth, cash flow, and sustainability. Let's take a further look. Chevron is the second largest oil and gas company in the US. It operates across six continents. It focuses on oil, natural gas, geothermal exploration, production, refining, and renewable energy. The revenue for Chevron mainly comes from upstream and downstream operations and mainly operating in North America, Middle East, and Asia. Let's see the story of Chevron. Good moves for a better cash flow. The Tengiz expansion is set to fuel sustained revenue growth and investor returns. Chevron has finally begun its production in its 48 billion US dollars Tengiz oil field expansion in Kazakhstan that aims to boost output to 1 million barrel per day, which is about 1% of global supply. This expansion will contribute to 25% of Chevron's total production, while there will be multiple factors that will drive Chevron's growth in 2025. This expansion alone is set to contribute 5% increase in revenue and generate $4 billion in free cash flow at a Brent price of $60 per barrel. This is a conservative assumption because the current, crude oil price is ranging between $75 to $80 per barrel, and Chevron also aims to distribute up to $80 billion to investors through dividends and share buybacks over 5 years using the free cash flow that is going to generate. AI power plants offer vast growth opportunities. We all have been hearing the disruption made by DeepSeek in the previous weeks. And acting on that, Engine Number One and Chevron have partnered with GE Vernova to build natural gas power plants next to US data centers, addressing the AI driven power demand. Chevron is focusing on building co located, smaller plants that enhance efficiency, reduce transmission losses, and enable scalable growth in the future. These projects are also designed for lower carbon integration that can capture up to 90% of carbon dioxide. The AI driven power demand is set to rise from 8 gigawatts to 23 gigawatts by 2027. A report by Goldman Sachs says so. Chevron aims to supply up to 4 gigawatts of the power by 2027, which meets only 17% of this demand, leaving a huge room for expansion for Chevron. Chevron refines its strategy by balancing growth, cash flow, and sustainability. Chevron is strategically optimizing its capital allocation by moderating spending on the Permian Basin in 2025, keeping its budget around $4.5 billion, which is lower than its budget for Permian Basin in 2024. By doing so, Chevron is shifting its focus towards two things. One being the growth of production in DJ Basin and Gulf of Mexico, where it's aimed to contribute 300,000 barrels per day by 2026, which is around 7% of production growth for 7% of total production for Chevron. The second thing being Chevron is allocating $1.5 billion of its budget towards reducing carbon intensity and expanding its new energies business. This shift prioritizes enhanced free cash flow over aggressive production growth and high impact, low carbon projects. Now let's take a look at the entire oil and gas. Resilience defines the 2024 oil and gas market. 2024 was a year filled with challenges with controlled oil supply, fluctuating demand and geopolitical tensions. Despite all that, oil prices remained quite stable, making it one of the most stable years in 25 years, where the crude oil per barrel price ranged between 74 and 90 dollars per barrel, which is quite interesting. And the industry also distributed $213 billion in dividends and $136 billion as share buybacks. The major players of this industry include ExxonMobil, Royal Dutch Shell, Chevron, BP, and Saudi Aramco that dominates the market. Next, we have oil field companies that are transitioning into energy technology companies to drive long term growth. As in the case of Chevron, like it's building AI power plants, we have ExxonMobil, Baker Hughes, which are transitioning into energy technology companies, which aims at expanding their client reach, reducing the reliance on cyclical nature of energy sector, helping them in diversifying their portfolio, and this will fuel the long-term growth and expansion of oil field service businesses. The oil inventories are set to stabilize with balanced supply and demand. According to IEA, there will be 1 million per barrel increase in demand and 1.6 million per barrel per day increase in supply, which makes the oil inventories are expected to stabilize as production and demand align. Let's look at the quarterly data for Chevron. The quarterly data shows that there has been 6% decrease year on year in revenue, and also this has led to 1% decrease in gross margin and 3.4% decrease in net margin. The main reason for this being lower oil prices. Next, the consensus estimates say that the majority of analysts, 73% of them, lean towards a positive sentiment, issuing a buy or strong buy recommendations. And according to them, the revenue growth is going to touch 5.6% by 2026. Now let's look at from where Chevron mainly gets its revenue. So Chevron has two main operations, upstream and downstream. The upstream includes exploration, production, and processing. Downstream operations include refining, distribution, and marketing. So it generated $193 billion of revenue in 2023, and 77% of its revenue came from downstream operations, and 23% of it came from upstream operations. Geographically, if we see, USA has been the major contributor of revenue, along with 45% of share, along with the other international regions which contribute to 55%. Uh, Countries like Kazakhstan, Canada, Australia, Indonesia, and so on. So the FVMR framework for Chevron states that Chevron has been assigned a neutral rating compared to 1,790 companies in the US, valuation and risk being its strengths, while momentum remains a key weakness because you can see the negative values in December 2023 and past 12 months values. Moving on, the profitable growth. Chevron's profitable growth over the past 12 months has remained average because of its poor growth, and the poor growth is being driven by poor revenue growth and poor expense direction. And the profitability has been also quite decent because of good asset efficiency and not so bad expense control, though there is a room for profitability. Now, this is the profit and loss statement. I have forecasted the revenue for 2024 to fall compared to 23 because of the fall in oil prices. The same has been can be seen in the net profit for 2024. But post 2025, there is an increasing trend in revenue and net profit. The total assets are also steadily increasing, and if you look at cash, the cash is also on an increasing trend because of its, like I said, Chevron has been doing a lot of activities that will drive the free cash flow growth, and the long term debt has been quite under control. Because Chevron does not believe in taking much of debt, but it believes in improving its operations and reinvesting the cash. And the dividend paid had dipped in 2024, but post that it's increasing. The EBIT margin is also increasing from 2024 onwards. The debt to equity ratio is between 0 and zero point 0.1. Like I said, the debt is pretty low. And return on equity had dropped in 2024 because of the low oil prices and low revenue, low profit, and so on. But post 2024, we can see an increase. The tax rate has also increased. The capex has been increasing, but it's not very concerning because the increase is, not too much. But if we look at the free cash flow to firm, that has been increasing really well because of the activities that I previously mentioned. Now, looking at the relative valuation, we have that Chevron looks comparatively expensive to the Asian and the world oil and gas companies, but it's cheaper related to the other companies in US. If we look at the ROE had fallen in 24, but I expect it to rise in 2025 to 10.4%. This ROE is in line with the Asian market, but it's not so good compared to USA and the world market. Now, looking at the PE ratio, we see that Chevron kind of looks overvalued because of its high PE ratio compared to the world market, US and Asia. But looking at the PE ratio alone will not give us the entire picture. So let's look at the EPS growth. When we look at PE ratio along with the EPS growth, we can see that Chevron is comparatively a cheaper stock. Like it is more attractive stock because the EPS growth, though it had been negative in 2024, it has improved vastly. It will improve vastly to 2025, and it's better than US and world if we look at EPS growth alone, but less than Asia. But then when we combine it with PE ratio, the we can see that Chevron is quite an attractive stock for the investors. Now, the valuation and target price. I have assumed a market risk-free rate of 3.5% for US market and equity risk premium of 10%, and the beta being 1.1 because it's an oil company and oil stocks are meant to be volatile. So that gives me cost of equity as 14.5%, and the WACC is 13.4%. Now, assuming all of this, I derive my target price using free cash flow to firm FCFF framework, and the target price that I derive is $195, which is on an upside of 30%, considering the base case scenario. Now let's look at both the optimistic and pessimistic scenario. In the optimistic scenario, if we assume that the sales growth improves by 8.2%, we have the target price as to $198. And in the pessimistic scenario, if the sales growth is 6.7%, the target price is $193. Looking at the risk quickly, we have geopolitical risks because Chevron operates in politically unstable regions, and the Kazakhstan expansion can be a little bit risky. Oil prices are meant to be volatile, so in order to mitigate this risk, Chevron is diversifying its portfolio. It's moving towards new energies business and investing in AI plants and so on. Regulatory and environmental risks. There have been stricter carbon regulations and climate policies that are pressuring Chevron. And in order to mitigate this, Chevron is also putting great focus on new energies business and reducing the carbon production and all that. So, having said all this, Chevron has a great potential for revenue growth. It is the free cash flow growth has been improving, as I said previously, and the P to EPS growth ratio, as we saw, makes Chevron a very attractive stock for investors. Having said all that, I initiate coverage on Chevron with a buy recommendation based on a target price of $195, implying an upside of 30%. Thank you.
Excellent. All right. So I think I got some questions myself, and we got some questions from the audience. So
Yes.
let's just see. Okay, let's go with the first question, which is, if oil prices go up, what will be the effect on Chevron?
If oil prices go up, then it's good for Chevron because the revenue will increase. Because as the oil prices were, low last year, the revenue had fallen. So it's a good thing for Chevron.
Okay. So Moman comes in with what's the one thing that could bring your recommendation to a sell?
One thing that could bring my recommendation to sell is if the policies of if the Trump's policies do not favor US, because mainly the geopolitical risks, I would say.
Right. Okay. And by the way, you got some nice comments here. So we have what a great presentation. And I like the comment that I saw earlier from Titipon, which is said very clear and concise, which I agree. Okay, let's look at, so we got a question here from AG. Why did you choose to use free cash flow of the firm instead of free cash flow of equity? As you mentioned, Chevron prefers to keep its debt low and stable.
I think the free cash flow to firm provides a holistic view, and because the activities that Chevron is focusing on mainly is to drive free cash flow. That is why I used free cash flow to firm.
And another one is related to your valuation. Why do you assume a beta of 1.1 considering the previous beta was kind of low?
No, the 10 years beta was 1.02, and I think 1.1 is quite reasonable if we look at that. And because it's an oil company, so the volatility is expected to be high. That's why I chose 1.1.
Okay. And Mohammed's got a good question, which is, isn't it too conservative with the emergence of a new Trump government in the US? Shouldn't conditions change in Chevron's favor?
Yes, conditions will definitely change in Chevron's favor if Trump favors the oil and gas companies and his policy of drill, baby, drill. So, yeah, it will be favorable.
I mean, it's curious why the share price is not moving already for the oil and energy companies.
The share price will start moving. It's not currently moving so much because of the strained relations between US and China. I think the geopolitical risk is quite high right now.
And what about Hess acquisition?
Yes, the Hess acquisition has been kind of on a stall because of ExxonMobil, but Chevron is quite confident about the acquisition that will come through. And if it happens that, then Chevron will have like really good oil fields in its portfolio that it gets from Hess.
I just listened to a good podcast about the story of Hess, the backstory, which was really, really fun. But let's go through a couple of others. So AG says, why was EBIT margin higher in 2022 and why couldn't the company sustain it?
Why was the EBIT margin higher in 2022?
Yeah.
The EBIT margin was higher in the 2022 and previous years. It fell in 2023 because it was investing too much in the Tengiz Kazakhstan expansion. That is why it fell.
Hmm. Okay. Uh, if low oil prices are affecting the margin in 2024, why do you forecast that the net margin will go on to increase in 2025, considering the state of the oil market recently?
Like I said, Trump's policies will, support the oil and gas industry. It is a positive thing. So that is why I have forecasted like a higher revenue and oil prices.
And from Mohammed, is Chevron the first company to move on such partnerships, or other companies also leading in this? And I'm assuming that's the partnerships related to the AI plants, or is that another partnership you think he's talking about?
I if it's related to AI power plants, then no. Chevron is second. The first before Chevron in December, ExxonMobil had come up with a similar project for AI power plants.
So Momin has a good question, and I'd like to go, if you can go back to your evaluation page,
Yes.
and he asks, even with the high, no, go down. Yeah, there you go, right there. The next one. Even with the, no, down, go down, the other direction. There you
Sorry.
go. Okay. Yeah, that right there. So even with the high weighted average cost of capital, you still get a 30% upside. Why is it so undervalued?
Undervalued or overvalued?
Well, what you're saying is you have a 30% upside, right?
Yeah.
So you're saying that the stock right now is undervalued
Yeah.
relative to the value that you calculate. But what Moment's saying is, you're first of all, your cost of equity is a bit high at 14.5, and your terminal growth rate is only 1%. So on just those two items, you're pretty conservative. Why is it, why is it, even with these kind of more punishing assumptions, there's still a huge upside compared to the market's expectation?
Yes, there's a huge upside because of the expansions that Chevron is doing. And secondly, because there will be a huge growth in AI, and because for the AI growth, Chevron has to supply more power. And as I assumed that Chevron will, expand its AI power plants as well. So
But
that
why do you
is
think the market's not seeing that?
because it has just begun. The project was just announced now, and it will see post 26, 27.
Okay, so they're waiting a little bit. Okay, next question comes in uh, from Nuruddin. What forms your conclusion to use a terminal growth rate of 1%?
Okay, for companies like Chevron, 1% seems quite reasonable instead of 1 to 2%. But I went a little conservative and chose 1% instead of 3 or 4.
And from this, we can see in your PowerPoint that the present value of the terminal period is only about 15 to 17% in your free cash flow models. So that tells me that your assumptions are pretty low for the terminal growth period. So let's go to the next page. I think your WACC is, your cost of equity is a bit high, and your terminal growth possibly is a bit low. So now let's look at the scenario of what that could mean if those changed. So let's go to the sensitivity, and here we can see. Let's look at the bottom two. What if discount rate change? Right now you're using 14.5. Let's say it goes down to 13.4. Share price goes to 209. Right, your calculation of value goes to 209.
Yeah,
And if we increase the terminal growth rate from 1 to 2%, it goes to 2.2. Let's say, or sorry, 202.
yeah,
And if we combine those two, we're probably talking about, let's say 6 points plus 9. That gets us to 215, let's say. And what's your target price? 195.
195.
So why not? Why not be more aggressive and say, this could go to 215?
No, because Chevron is dialing down on its aggressive production, like I previously mentioned. It is shifting its strategies towards carbon capture and Mexico and DJ Basin and so on. So that's why I made a few conservative assumptions.
Okay, you got a lot of questions there. That was pretty great. Congratulations. How does it feel to graduate from the Valuation Masterclass Bootcamp?
It feels great. It feels like the hard work that I put in for all these 6 weeks has finally come to fruition. So I feel good about it.
That's wonderful. And tell us about the transformation that you went through in the Valuation Masterclass Bootcamp.
Yeah, well, I did not just transform into a person who can value companies, but I also transformed into someone who values their time even more now because I never thought that I would be able to value a company and create such a comprehensive report in just 6 weeks. But because of my consistent efforts and because of the constant push from you and the entire team, I was able to do it. It made me realize that maybe I was underestimating myself. I can do more things in shorter span of time. So that is what I learned.
You remember that video I showed in the boot camp where the guy had the kid on his back and he said, "I want your very best." And he had him
Yes.
run across the field, and the kid thought he could make it to the 30-yard line. And then he said, "I've got to be at the 50 by now." And he was blindfolded. And at the end, he said, "You're at the end zone," meaning he went 100, 100 yards. So way beyond what your
Yes.
potential is. So you've got huge potential, and you've been able to bring it out here. Remind us how you found out about the Valuation Masterclass Bootcamp and why you eventually decided that you're going to devote your time to this.
So I found it out through your LinkedIn post. I actually missed the deadline for the previous boot camp, and I was kind of disappointed. So I kept a close tab on when your next post will come out for the next valuation masterclass. And as soon as it came, I applied for it. The reason why I applied for it because when thinking in hindsight, like I wanted to pursue CFA, and I was like, maybe I should take up something related to that, like a valuation masterclass that would help me like test the waters, like if I'll be able to do this and how much of my time and effort will it require and all that. And I must say that I was able to achieve that goal of mine, and it built like a great foundation for my future goals.
And what was one thing that surprised you once you got into the boot camp that you didn't realize when you read the page, the website, and all that? What was one thing that you would say positively surprised you in the boot camp?
Uh, when you said that we will make friends for life and things like that, I was kind of skeptical because there are a lot of people coming from different cultures, different backgrounds. I was kind of skeptical if people will be able to gel in well, and and so on. But I must say that I ended up making some really good friends. They're really supportive. They always check up on me, and I do that for them. So I feel really good about that. And one more thing that I want to add is when I was looking at the website while applying, you kept saying that you only if you survive 6 weeks you'll go for the next, only if you survive. I was like, is he being a little too extra, or is it going to be that difficult? But when I actually got in, I realized how difficult it is, and I'm glad I made it through the 6 weeks.
All right. Well, I'm going to congratulate you right now. Well done. And we're going to end this session. And but I just want to say you've done a great job. The presentation was great, and keep up the great work. We'll talk more
Thank you,
soon.
Andrew.
Okay. All
Yeah.
right. Hold on. Pretty awesome, huh? If you want to build a competitive advantage in company valuation, just like Anusha, join us in the Valuation